Hi, I'm Matt McAleer, and I'm with John Mousseau, head of our fixed income. I'm director of equity trading here at Cumberland Advisors. It is just past the close on January 4th. John's going to take a couple of minutes to talk to you a little bit about the bond action we saw this week and some of the things on the active side of bond management that Cumberland took advantage of. If you recall, 5.5 weeks ago, John and I were on, and John was talking about extending maturities and trying to take advantage of that 320, 325, 10-year treasury. Well, since then, we've had a rip higher in prices, lower in yield. Thursday, we were at 255 on the 10-year. And I just wanted John to give you a little bit of color on how he handles something like that.
Thanks, Matt. Just to follow up, when bond yields were much higher back in the fall, late fall, we did take advantage of that both in the taxable and tax-free side in terms of extending maturities, extending durations, buying longer bonds. And this included buying some long municipal bonds in the 425, 430 range, discounted bonds. And the change in scenario with the volatility in the equity market has seen yields come down. And Matt mentioned how the 10-year bond yield had fallen all the way to 255. It's around to 260 right now. The interesting part is that when you were at about a 330, which was really the peak for the year in the fall, 2018 started out at around a 260. And here you are, in about 5 or 6 weeks, you made up all the ground in one fell swoop, and yields are back down. This has meant that it has taken a lot of bonds that we bought late in the year and made them appreciate a lot. How does a total return manager take advantage of this? A couple of ways. One, realizing that the beginning of the year in January is usually one of the biggest influx of cash into the bond markets. It's from maturing bonds, called bonds, coupon payments, most of which are in January or July, and that money's looking for a home. And whereas in other years it might have leaked into the stock market, some of the volatility is maybe keeping that reinvested into bonds. What do we do here? Well, we look up and say, supply is very down because at the beginning of the year, most of the investment bankers aren't back, the calendar has not built, there's not too much in terms of deals, but there is a lot in terms of demand. So we try to step into the middle and call it what we call feed the beast and sell a few bonds into the retail systems where the demand is high at prices that we think and know are much higher than they were just a few weeks ago. And we're not afraid to sit on the cash a little bit till we get to the spring. So that's how a total return manager has it. And Matt, thanks for having me on.
Well done, John. Over on the equity side, constructive week. And let me back up a little bit and tell you why I say constructive. We all know, we recall that this Christmas Eve we had a nasty downdraft followed by a rally, a straight rally off of lower lows. Very tricky scenario to trade. You're really guessing at that point. Did we see a low? Do I have value? What can I trade up against? This week, almost ideal going forward. Doesn't mean we're going higher in a stair-step fashion here, but the Wednesday rally followed by Thursday's downdraft yesterday at a higher low than Christmas Eve now gives us something to trade against. If you are somebody who's been trading in the markets and try to marry fundamentals to technicals, to chart action, to activity in the markets, you're always looking for that higher low in weak markets. So with today's action, Dow up 750 and many of the indexes up 3-4%, we've created that higher low. So Jan 3 versus December 24th, we can trade against that now. Gives a equity manager, or really a trader in any asset class, something to trade against, something to lean on, something to see if we do start to drift back, how does the market react at those previous lows? Tough to do at the lowest low. A little more constructive to do at a higher low. So we'll see what next week brings, but today's action was very helpful. I wanted to add one other note for our clients. We're going to start doing an extended version of our Friday trading call as a quarterly piece. It's going to be a wrap on our equity and fixed income trading and thoughts on a quarterly basis. That will be more of a 10 or 15 minute take. So we're going to get together with marketing and see what makes sense for the next week. But that will be a quarterly piece to follow up on our weeklies. Have a great weekend. We'll see you next week.
Thanks, everyone.